BRICS have tried for many years to end the dominance of the US dollar, but all the de-dollarization efforts have failed so far. With Donald Trump's return, China sees an opportunity to strike at the dollar, and this time it could be devastating. Unlike in the past, China no longer views the US as untouchable. Things have changed a lot.
It is interesting, actually, when you go around China, is the US is not really part of the equation anymore. It used to be, but less and less so.
Trump's policies, intentionally or not, are creating the perfect storm for China's de-dollarization playbook. So what exactly is Trump doing that's got Beijing so optimistic? And how is China using this moment to accelerate its plan to dethrone the dollar? We're breaking it all down in this video. But first, make sure to subscribe to the channel. It helps a lot and ensures you never miss a global money shift like this one. In a surprising turn of events, President Donald Trump's trade policies, meant to isolate China, are instead strengthening it, while pushing traditional US partners away. As more countries grow frustrated with harsh US tariffs and trade barriers, China is quietly stepping in to fill the gap. Beijing is forming new partnerships, expanding its global influence, and boosting the international use of its currency, the yuan. In fact, cross-border yuan usage has jumped by 21.1%, a clear sign that the global trade landscape is shifting. Trump's tariffs have made it more expensive for many countries to trade with the US, prompting retaliation from the EU, Canada, China, and others. The result? A fractured global economy now split into competing trade blocs. Economists warn this trade war is likely to harm the US in the long run by stifling investment and increasing uncertainty for businesses. Instead of giving in, China is making smart moves to take advantage of the situation. Countries that once traded heavily with the US are now looking for alternative partners, and China is offering them better deals. In Asia, countries are following a new strategy called America Plus One, which means they no longer rely on the US alone but look for additional partners like China or India. Even though the US is still a big player in global trade, these countries are actively reducing their dependence on it. China is wasting no time in growing its trade partnerships. In 2024, trade between China and the European Union reached $762 billion, growing by 1.6%, making the EU China's second biggest trading partner. Trade with Africa also grew by 10%, reaching $280 billion in the same year. While the US builds walls through tariffs, China is building bridges. Instead of fighting with other nations, China is forming long-term economic deals and investing in countries through its Belt and Road Initiative. This project, which builds roads, ports, and railways in different countries, helps China secure trade routes and strengthen its influence worldwide. At the heart of this strategy lies a major ambition: reduce global dependence on the US dollar. In 2010, over 80% of China's global transactions were done in US dollars. But by 2023, over 50% of China's trade was done in yuan instead. This is a huge shift and shows just how quickly China is moving away from using the US dollar. If this trend continues, the dollar could lose its top position in global trade, and China will gain even more financial influence over the world economy. Why is this such a big deal? Because China is the world's second largest economy. When a country of that size reduces its use of the dollar, it's not just symbolic. It's hundreds of billions in trade that no longer flows through the US financial system. In 2024, China's foreign trade reached a record high of 44 trillion yuan, approximately $6 trillion. This marks a 5% increase from the previous year. So China's international trade is increasing, but guess what? The US dollar is not being used for most of this trade. If China was using the US dollar for this 5.9 trillion trade, that would have been a big boost to the United States. But now the US is missing out on this trade and cannot get this volume from any other country in the world. For decades, the dollar's dominance gave America an unmatched influence over global finance. But that dominance is eroding, not just because of China's ambitions, but also because of US policy missteps. As more countries pivot toward the US economy faces two critical risks. First, Reduced global trade in dollars means less demand for the currency, weakening its value and America's financial leverage. Second, as the yuan gains traction, China's influence over the global economy grows, giving it more power to set the rules of international finance. And China isn't just relying on trade to tip the balance. Behind the scenes, it's also taking bold financial steps that strike at the heart of the U.S. economic system. One of the most significant? Its deliberate reduction of U.S. Treasury holdings, a move that has sent shockwaves through global financial markets and signaled a seismic shift in international economic power dynamics. This strategy not only undermines the dollar's dominance, but raises serious concerns about the stability of the entire global financial system. Over the past decade, China has gradually scaled back its investments in U.S. government debt. As of 2025, it has now marked 9 consecutive months of divestment, reducing its holdings to levels not seen since 2009. But this isn't just a Chinese trend. Other key economies, including Japan, the largest foreign holder of U.S. treasuries, are also cutting back. This reflects a broader global move away from dependence on U.S. debt and, by extension, the dollar's long-held dominance. The implications are far-reaching. By selling off U.S. Treasury securities, China not only reduces its exposure to American financial risk, but also pulls back a critical source of funding for the U.S. government. And it comes at a particularly vulnerable time. In 2025, the United States faces a massive refinancing cliff. Over $10 trillion in debt is set to mature, much of it issued during an era of historically low interest rates. The average coupon on this maturing debt is just 2.5%, but the new debt replacing it will carry a much higher average rate of around 4.5%. That shift alone will add approximately $200 billion to the federal deficit in a single year, without any new spending. If other major economies follow China's lead in reducing their treasury holdings, demand for U.S. debt could weaken further, pushing borrowing costs even higher. This not only strains the federal budget, but also undermines confidence in the dollar's long-standing role as the world's safe haven currency. So why is China doing this? At the core is risk management. By diversifying its foreign exchange reserves, Beijing is seeking insulation from U.S. economic instability and the increasing use of financial tools as geopolitical weapons. China's retreat from treasuries also aligns with its larger goal of de-dollarization, a trend now gaining momentum among nations wary of the U.S.'s fiscal unpredictability and aggressive policy decisions. The repercussions of these actions are already manifesting. The U.S. national debt has now exceeded $36 trillion, with interest payments reaching 4.7% of GDP in 2024, a historic high. Fears of a potential default are growing, especially with warnings that the U.S. could breach its debt ceiling as early as July 2025 if Congress fails to act. Such a scenario would send shockwaves through global markets, given how central the dollar is to international finance. Meanwhile, the Federal Reserve's efforts to calm the markets have had limited success. Policy uncertainty, rate shifts, and past quantitative easing have done little to slow the decline in foreign investment. With China stepping away from U.S. debt, the U.S. may be forced to pay more to borrow, pushing up interest rates and increasing financial volatility. In short, China's treasury sell-off isn't just a portfolio adjustment, it's a strategic warning. A clear signal that the global financial system is shifting and that America's once unquestioned financial dominance is now under serious challenge. The United States has used the dollar not just as a currency, but as a powerful tool of geopolitical influence. This was made clear when Washington froze approximately $300 billion in Russian assets following the invasion of Ukraine. While the move signaled a firm response to aggression, it also sent a chilling message to the rest of the world. Dollar reserves can be weaponized. Nations worldwide, observing the U.S.'s capacity to leverage its currency dominance as a geopolitical tool, are now reassessing their financial strategies to mitigate potential vulnerabilities. China, already locked in rising tensions with the U.S. over Taiwan, has grown increasingly wary of its own dollar exposure. The fear that its vast reserves could be frozen in a future conflict has led Beijing to accelerate efforts to reduce its dependence on the dollar-based financial system. And it's not just China. Traditional U.S. allies, including Europe, Canada, and the United Kingdom, are also rethinking their reliance on dollar reserves. The unpredictability of U.S. foreign policy and financial sanctions has introduced a new layer of risk, prompting many countries to seek greater diversification in their reserve holdings. Geopolitical concerns are only part of the picture. Economic factors are also eroding confidence in the dollar. Declining bond yields have made U.S. debt less attractive, and the Federal Reserve's quantitative tightening, QT, which allows treasuries to mature without reinvestment, has reduced liquidity in the bond market. This puts upward pressure on interest rates, slows economic growth, and makes U.S. assets less appealing to foreign investors. Even central banks in Europe have begun reducing their purchases of U.S. debt, further weakening global demand. Combined, these forces are reshaping how nations view the dollar, no longer as a stable store of value, but as a potential liability in an increasingly fragmented and uncertain world. Over the past year, gold has reemerged as a powerful force in global finance. Driven by rising geopolitical tensions and growing economic uncertainty, gold prices have surged, reflecting a renewed appetite for security in an increasingly unstable world. By mid-March 2025, gold surpassed $3,000 per ounce, marking a more than 40% increase since the end of 2023. This is no speculative spike. It's a response to real-world anxieties, escalating conflicts in the Middle East, fears of a global trade war, and the weakening appeal of traditional financial assets. In such conditions, gold's reputation as a safe haven is proving stronger than ever. Central banks worldwide have played a pivotal role in this gold rush. In 2024 alone, they added about 1,045 metric tons to their reserves, the third year in a row that global purchases exceeded 1,000 tons. Poland led the charge with a 90-ton increase, while India and China followed closely behind. Notably, China resumed its gold buying in late 2024 after a brief pause, signaling its strategic intent to diversify away from the US dollar. Europe has joined this trend as well. The European Central Bank has seen the value of its foreign reserves rise alongside gold, providing a buffer against dollar volatility. This shift underscores a broader global movement, a pivot toward hard assets as central banks look to safeguard wealth in a time of growing fiscal and geopolitical risk. The implications are significant. As more countries pour money into gold, they are effectively questioning the dollar's reliability as a long-term store of value. This growing preference for gold over fiat currencies, especially the US dollar, points to a slow but meaningful rebalancing of global financial power. If the momentum continues, we could see a fundamental reshaping of the international monetary system, one where gold reclaims its historical role as a cornerstone of reserve strategy, and the dollar loses ground to harder, more politically neutral assets. In this emerging order, the US may find its influence fading unless it adapts. The world is diversifying, and gold is leading the way. So the question is, are we witnessing the beginning of a post-dollar world? And is gold the new king of global finance? If you found this analysis insightful, don't forget to like, subscribe, and hit the notification bell so you never miss a story that could shape the future of money.